Yo guys, welcome back to another video here at Trader Journey on YouTube. Today we're covering off a very quick video. I'm hoping it's going to be simple for you guys to understand. We're going to be talking about strike prices and specifically about in the money scenarios. But just before I get into the video, if you haven't checked out my Instagram yet, it's TraderJourney_official. I upload there a lot of details and tips and tricks for trading. So if you haven't checked it out, be sure to check it out. I'll leave a link in the description box below. And let's get straight into this video. So like I said guys, we're going to be talking about in the money contract strike prices. Now a lot of people have had confusion. I'm getting a lot of messages on Instagram and in the comments on YouTube as to what these sort of mean, these different scenarios: in the money, at the money, or out the money. In this video I'll specifically be talking about in the money, and I'll be uploading 2 other videos explaining the process of out the money and at the money contract strike prices. So for this video it's talking about in the money, and we're specifically talking about this specific scenario. So in the money, where do we start? So otherwise known as in the money or ITM, you'll see me refer to this particular scenario as ITM across social media and maybe in the chat. You can buy in the money put contracts as well as in the money call contracts. So they apply to both scenarios. Whether you're going long or short on a stock, you still have the opportunity to buy in the money contracts, whether you're buying put contracts or call contracts. So quite simple to understand, but hopefully that makes sense to you guys. It's also important to understand when to purchase a in the money contract and when to avoid them. There's specific scenarios which I'll be talking about in this video as to why you should buy in the money contracts and when you should avoid it, because they do help in certain scenarios and they do help make certain plays and certain trades more lucrative than if you were to, for example, play out the money or at the money contracts. Cool. So I guess let's go through an example which specifically explains an in the money example. So say for instance you were buying a put option contract which was in the money. These would be specifically strike prices above the current stock price. So an example would be if a strike price of £100 is considered in the money, then the underlying stock should be valued at £90 at that point in time, because the stock price has already moved below the strike. So when you're obviously buying put contracts, you're suggesting that the stock price is going to go down. So if you're buying an in the money options contract, put options contract, the move would have already happened in the direction you're expecting. So a strike price of 100 and the underlying stock value being £90, the underlying stock price is already below the strike price, which means you're already in the money and the contract's already made the money on that move, on that expected move. And say the stock price went from £90 down to £80, so you can imagine your contract price would increase at a faster rate because it's already in the money. So generally in the money contracts have a higher delta, so any move in the price, you'll expect your contract price to fluctuate at a higher rate than if you were to, for instance, buy a out the money or at the money contract. So let's give another example talking about in the money call options contract. So it's a very similar strategy, similar scenario, but we're obviously flipping it and now we're going long on a stock. So therefore these are those that have strike prices below the current stock price. A call option with a strike price of £100 is considered in the money if the underlying stock is valued at 110, because the stock price has already moved above the strike. So the move has already happened. And it's already, for anyone who had bought call contracts, that move has already played out. And if that stock price was to go from 110 to 120, then you can imagine the contract which you're holding, which is in the money, the delta being much higher, you will expect a greater appreciation in the contract price. Therefore, if you're scalping, you generally want to go in the money, and that's where you make a significant amount of money when scalping. You want to be going in the money. So this is basically a follow on from what I've just said. But when to buy in the money contracts, as a general rule, you should only buy in the money contracts when scalping. So you would generally only be in the trade for no longer than 3 to 5 minutes. The reason why an in the money contract is more beneficial when scalping is, like I said, that the delta is higher. So I'm going to put a screenshot on this video now so you can see the options chain. So you can see in the column where it says delta, you can see when you've gone in the money, the delta is higher. So therefore any move in your expected direction, the contract price will be higher. I'll make it, I think I've made a separate video. If not, I'll make a video explaining what delta is. But delta is effectively the rate at which your contract changes in terms of price depending on the dollar move in the underlying stock value. Therefore, scalping within the money contracts, you can earn more from a scalp as the contract price will increase at a faster rate than, for instance, buying at the money or out the money. Now in the screenshot you can see here, guys, that at the money or out the money, the delta is not as high. So you don't want to be scalping with at the money or out the money. You want to be, because you're only in the trade for such a short period of time, you want to maximize the delta. So it's important to go in the money when scalping. I hope that makes sense. If there's any questions, leave it in the description or leave it in the comment section below, sorry. So some last remarks here, guys, is keep in mind that although the delta is high, if the stock price goes against your intended move, the contract price can decay fast also. So ensure you set up a stop loss, a tight stop loss when scalping, because keep in mind that you're only in the trade for 3 to 5 minutes, so the stock can fluctuate quite a lot depending on what you're trading. So you want to keep your stop loss ready to go and quite tight to your entry point. This will ensure that you minimize any potential loss when scalping. And if the move happens in the direction, you want to be out the trade within 3-4 minutes, max 5 minutes. If the move is getting a lot of volume and it's going in the intended direction, then possibly maximum 5 minutes. Now when scalping, you generally go into the trade quite heavy, so you buy more than one contract. So for instance, if you're scalping Apple, you would want to get 2 or 3 contracts. Therefore you're going in heavy, you're only in the trade for 3 to 5 minutes, and you're making bigger returns on a smaller price movement. So there's so many variables here. Firstly, the delta's high. Secondly, you're going in heavy. So I know a lot of people that just scalp because that works for them, that trading strategy works for them, and is generally a good way to make quick returns. But you generally put a lot more money into the trade expecting a higher return because you've gone in the money. I hope that makes sense again. So that's all that covers this video, really, guys. I just wanted to make it quick and easy for you guys to understand. I hope I didn't make it any confusion for any of you guys. So if you've got any questions, leave it in the comment section below. Hit me up on Instagram, as I'm always helping people out over there. And I will catch you all on the next couple of videos. So the next 2 videos will be discussing out the money and at the money. So thanks very much for watching. Take care. Goodbye.